Around the world, central bankers are grappling with the tricky prospect of bringing down inflation while keeping the economy afloat.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
And some have already started cutting interest rates.
The Governing Council today decided to lower the three key ECB interest rates by 25 basis points.
Back home today, RBA Governor Michelle Bullock left rates on a hawkish hold.
Inflation is still above central bank targets in many economies, and it is proving to be sticky.
His decision came as no surprise to economists, with most predicting the bank would leave rates on hold at 4.35%, unchanged since last November.
I think the RBA probably should have increased rates a little bit further, probably closer to around 5%.
While the RBA governor conceded higher for longer rates are hurting the economy, she said fears of a recession are unfounded.
They've got jobs, and I think that's really important for the future.
While the RBA is battling inflation, the big question for borrowers is when interest rates will start to come down.
We think we'll see an easing cycle running at about a quarter percentage point a quarter, so 4 cuts following a November cut as well.
Realistically, it could even be as late as the middle of next year.
A critical few months ahead.
Hello everybody. So the topic of today's video is when is the property market going to collapse? And that depends, completely depends on the controllers of the financial system. If they wanted it to collapse tomorrow, they can very easily engineer it. They kind of seem to be working towards it by jacking up the interest rates, which they have done in the last few years, despite saying that they were not going to do it until 2024. Yet they did exactly that, or exactly opposite to what they promised they wouldn't, as I talked in my previous video. And so can very easily do it by, again, jacking up the rate is fine, but if they continue to provide liquidity or provide credit, give people money, even albeit at a higher rate, which is less affordable, fair enough, they could actually just turn the taps off. If you they could virtually actually do it by jacking up the interest rates even more and saying, okay, we're happy to lend you money, but your repayment is $10,000 a month, and then virtually they've really closed the credit lines for most people, and the game is over at this stage. Something I believe that may happen, and it's like what is it? Royal Bank of Canada, or the Reserve Bank equivalent or Fed equivalent in Canada, have cut the cash rate by 0.25%. That was kind of expected from some of the central banks, if not all of them. They may give this appearance of interest rates now turning around, going down once again, and the assumption would be that they will come close to zero again, and the money will become cheap and the property will continue to go up. The prices of that and other assets will continue to go up. But I think that will be a false move. I'm not the only one who said this, but they'll just take it down a bit, give that false hope, a false move. People may still think, oh yeah, this is it. This is a continuation of the same cheap money. We're going to get that cheap money again. They jump back in, and then they get trapped again after they push the rates up again, as the trend is clearly up, very clearly up. So they can engineer it very easily. And once again, they've kind of started it, but they can't just give away the game straight away. They can't just go straight up with the interest rates the same way that they'll go straight down. Although when it goes down, it'll go down by the elevator very fast enough, or much faster than it's gone up. And the whole reason why the assets, including property, has gone up in the last 30 years is that it's really a low interest rate cycle. The interest rates have been dropping ever since the late 80s, when they peaked at, what was it, like 17 or 19% here in the United States, was very similar. And they've been going down ever since. Again, not in a straight line, but generally, and trend has been down up until 2020, when we know what happened. That was the low, and then it bounced up, and the next 30 or 40 years will be up. And we know what happens when the interest rates go up, because the value of all this property that we see everywhere is actually predicated on how much people can borrow. It's not what it's worth. It's not how many yearly salaries you need to, average yearly salaries you need to buy an average property. Nothing to do with that. It's just whether you can service the loan, and if your mortgage was at 3%, then you can borrow a lot of money and pay anything, or pay a lot of money for anything. That's really the bottom line. Maybe I said something that most people see, but I've realized that a lot of things that seem to be, or would have to be, common knowledge and easily read and understood, people don't seem to see. I talk to friends and they just don't see it. They think if the interest rate's gone down, as a trend down since the late 80s, as if they were and are going to somehow continue to go down or touch 0% and stay there. I mean, interest rates, like everything else, has gone up and down, but everyone seems that the up is no-go anymore. How's that even possible? I mean, they will have to go up, and they did. They touched zero in 2020. They had to reverse. You can't go below zero, yet they kind of try that trick. European Central Bank had their bonds at a negative coupon, which is insane, but they did try it. So it went zero and below zero. The next way is up.